Welcome back to PWM Pathway. This is lesson 3, and now we're going inside the machine, how private banking actually works, the team model, client service delivery, revenue streams, and how the industry has evolved since the 1990s. As lesson 2 was about what the business is, this lesson is about how it operates. Let's get into it. As always, a quick disclaimer, the views expressed here are my own. This is educational content and not financial advice. So, what does a private banking team actually do all day? It's not one person managing portfolios alone. It's a coordinated team delivering an institutional grade service to individuals. And understanding this machine, how the team works, how clients are serviced, and how revenue is generated is what separates candidates who get offers from those who don't. Let's start with the team. In this example, we're talking about a roughly 25 million net worth relationship. They are large enough to meet most private banks' $10 million minimum and to be receiving advice from a full bench of professionals. Every private bank client is covered by a coordinated relationship team with different specialists brought in depending on the client's needs, complexity, and size. The private banker is the quarterback of the relationship. They own the client, they coordinate everything. Around them, you have the investment specialist, responsible for portfolio development and asset allocation, the credit officer, who handles lending structures and risk assessment, the estate and trust planner, focused on wealth transfer and tax optimization, the alternative specialist, covering PE, hedge funds, VC, and co-investments, the advisory specialist, handling specialized needs like art, aviation, yacht, and philanthropy, and the CIO strategist, representing the Chief Investment Office, with macro views and global thought leadership. That's 7 specialists from 7 different teams, all coordinated around a single client. And as the analyst, you sit at the intersection of all of it. Let's overview what each role actually does. The private banker owns the relationship. They coordinate across all services, understand the full financial picture, and are the first call for any need. The investment specialist builds and manages the portfolio, presents allocation recommendations, and executes rebalancing and opportunistic trades. The credit officer structures lending solutions, such as mortgages, security-backed lines of credit, aircraft and yacht financing, and manages risk for the bank. The estate and trust planner designs wealth transfer strategies, coordinates with outside attorneys and CPAs, and manages trust structures and tax planning. The advisory specialist advises on needs beyond the portfolio. This could include art, aviation, yachts, and philanthropy, and helps structure these major purchases. The alternative specialist sources private market opportunities across PE, VC, hedge funds, co-investments, and direct private investments. They conduct due diligence and explains the strategy and fund fit to the client. And finally, the CIO strategist represents the Chief Investment Office. They deliver macro views and market outlooks and translates the CIO strategy into client portfolio positioning and thematic ideas. Every one of these people touches the client. That's the team. Now let's talk about how the client journey begins. There are 5 stages. Stage 1 is prospecting and referral. At the high end of wealth, client acquisition looks very different from retail finance. The vast majority of clients, roughly 90%, come through warm channels, whether it be referrals from existing clients, introductions tied to investment banking or corporate banking relationships, their attorneys, accountants, or broader social and professional networks. Cold calling is exceptionally rare at the top. Stage 2 is the discovery meeting. This is a thorough initial conversation between the advisor and the client or prospect. It serves as a deep diagnostic, assessing current assets, liabilities, family structure, goals, risk tolerance, tax situation, and other existing advisors. You're also understanding softer elements, how the client makes decisions, what they care about, where they've had bad experiences in the past. This conversation serves as the foundation for the entire relationship. Now, stage 3 is the actual proposal and onboarding. Once the advisor has a full picture, they translate that into a coordinated plan. That includes an investment policy, which is how the portfolio should be allocated and why, alongside any lending strategies, estate and trust considerations, and an overall service plan. In addition to strategy, it's execution. Opening accounts, transferring assets, completing documentation, going through compliance and operationally everything that's discussed. It can be complex and sometimes slow, especially with large or cross-border clients, but it's critical to get right. Stage 4 is just ongoing advisory. That includes regular portfolio reviews, which are often quarterly, market updates, portfolio rebalancing, and any new investment ideas, but also supporting major life events. When a client sells a business, for example, or inherits wealth, when they go through a divorce, when they relocate jurisdictions, or perhaps decide to engage in philanthropy, the advisor is coordinating across the entire team to adapt their strategies. This is where trust is built, frankly, through consistency, responsiveness, and good judgment over time. And then finally, stage 5 is the next generation engagement. Now, at the highest level, private banking is not about managing money for one individual. It's about managing wealth for a family across generations. That means building relationships with the children early, educating them on financial literacy, helping them understand the structure of trusts, and preparing them to eventually take over the responsibility of wealth. If done well, the relationship outlives the original client, the assets transition, but the advisor and the institution remain. Now let's bring this entire process to life with a notional client profile. Let's deep dive into the Cheng-Rossi family. The Cheng-Rossi family. The patriarch is David Cheng, born in Hong Kong, educated at Cambridge, and built a $450 million net worth across logistics and commercial real estate in Southeast Asia, namely Singapore. His wife, Isabella Rossi Cheng, is Italian-born, a former contemporary art dealer, and now runs the family's philanthropic foundation in London. They have 3 children. The eldest daughter is at Wharton, finishing her bachelor's. The middle son is boarding at Phillips Academy Andover in Massachusetts, and the youngest is still in primary school in New York. Now look at the entity structure. They've got a Hong Kong holding company for the logistics business, a Singapore family office managing the liquid portfolio, a British Virgin Island or BVI trust for intergenerational wealth transfer, a Swiss custody account, and a London-based foundation for philanthropy. 5 jurisdictions, multiple legal entities, multiple currencies, and this is really what ultra-high net worth complexity looks like. And this is exactly what private bankers are built to manage. Now, how does a $450 million family arrive at a private bank? There are 5 common pathways. Pathway 1, existing relationship referrals. David Cheng's friend is already a client at the bank. Over dinner, the friend introduces David to a senior private banker. Trust is transferred through a trusted intermediary. This is the most common way ultra-high net worth clients arrive at a bank. Pathway 2, internal referral from investment banking or markets. The bank's IB team advised David's logistics company on a minority stake sale. After the deal closes, the deal banker introduces the family to the private bank to manage the liquidity event proceeds. This is the IB to PB pipeline in action. Pathway 3, center of influence network. The Cheng's family accountant has a strong professional relationship with the private banker, and they often refer business to one another. During a tax planning session, the family accountant mentions to David Cheng the bank's strong cross-border capabilities and makes an introduction to the banker. The banker follows up with a tailored capabilities presentation. Pathway 4, direct outreach by the banker. A senior private banker has his analyst identify the Cheng-Rossi's family through public filings and industry events. The banker then outreaches and builds a relationship over 12 to 18 months. This includes invitations to conference panels, dinners, thought leadership from the chief investment officer, and all the other resources provided before any business is ever discussed. This is the long game. No pitch, just proximity and credibility built over time. And Pathway 5, the next gen pathway. The eldest daughter connects with the bank through a young professional's wealth event while she's at Wharton. She brings the family relationship in. The bank earns the next generation first, and the parents follow. Every single one of these pathways is relationship driven. The bank earns proximity through trust, expertise, and patience. And that's exactly why the people in these roles need to be sharp, credible, and relationship oriented from day one, which is what this entire course is preparing you for. Now, what does the Cheng-Rossi family actually need from their private bank? First is multi-jurisdictional banking. This family operates across the US, UK, Singapore, and Hong Kong. That means 4 different legal systems, tax regimes, regulatory environments, and banking infrastructure. They need the ability to move capital seamlessly across borders, hold accounts in multiple currencies, and coordinate entities and reporting across jurisdictions. This is not just about opening accounts. It's about ensuring that everything works together without creating tax inefficiencies, regulatory issues, or operational friction. Second is lending and liquidity. A significant portion of their wealth is tied up in illiquid and concentrated assets. This is their business equity in their Hong Kong logistics company, as well as commercial real estate in London and their large equity stock positions. They don't want to sell those assets every time because they need cash. So the bank provides structured liquidity, lending against those holdings to fund major purchases like additional property acquisitions in London or to create flexibility for lifestyle spending, philanthropy, or reinvestment. The key here is balance sheet optimization, accessing liquidity without disrupting long-term investment strategy. Now, third is investment management, but on a global coordinated basis. Just like their banking is cross-border, their portfolio is as well. They need a unified investment strategy across public, private markets, and cash, while actively managing currency exposure across dollars, pounds, Singapore dollars, and Hong Kong dollars. At the same time, this is not one portfolio, it's multiple. Different family members have different risk tolerances, time horizons, and objectives. The challenge is building portfolios that are individually appropriate but collectively coherent at the family level. Fourth is trust and estate planning. As wealth scales, the focus shifts from just growing assets to preserving and transferring them. The Cheng-Rossi family needs structures that allow wealth to move efficiently across generations and across borders, to include trusts, holding companies, and government frameworks that define control, decision-making, and succession. This is where financial strategy intersects with family dynamics, and it's part of the reason that private wealth management is so interesting. Poor planning here doesn't just create tax inefficiencies, it actually creates familial conflict. Fifth, family office and next generation advisory. The goal is not just to manage wealth, but to prepare the next generation to inherit it responsibly. That means educating children on investing and stewardship at an early age, building governance structures like family investment committees, and gradually transitioning the children into decision-making roles. For example, because the eldest daughter is about to graduate from Wharton and enter the family ecosystem as a working adult, the bank may help formalize a governance charter, define her role, and align the trust structures accordingly. Now, this might all sound very complicated, but when the family spans dozens, if not hundreds of members, then this is crucial. This is where private banking becomes long-term family advisory. Now, sixth and finally is philanthropy and legacy. The family is not just deploying capital for returns. They are also deploying it for impact. That could mean running a charitable foundation, coordinating giving strategies across jurisdictions, and aligning philanthropic activity with both tax efficiency and personal values. For instance, a London-based foundation may require a giving strategy aligned with European frameworks, impact measurement, and coordination with the broader family structure. If done well, this becomes a central part of the family's identity and a key driver of long-term relationships with the bank. This is why private banking exists. No single product serves all of these needs. It takes an entire platform working together under one relationship. Now, how private banks operate from a business perspective. Private banks make money through 4 primary revenue streams. Understanding this is critical because it explains how both the business operates and where the incentives come from. So the 4 primary revenue streams are first, and the largest at roughly 45%, AUM-based fees. A percentage of assets under active discretionary management, typically 50 to 100 basis points, are charged on separately managed accounts. Second, at about 25%, is lending spread, the net interest margin on mortgages, credit lines, and securities-backed lending. Third, at roughly 18%, is transactional revenue, trading commissions, FX conversion, structured product fees, and brokerage. And fourth, at about 12%, are alternative placement fees. These are the fees for placing clients into private banking, hedge fund, private equity, direct private investments, and co-investments. There usually are revenue share agreements between the fund and the bank. These are overall just directional estimates. Actual breakdowns vary by firm, and you can find them in their annual reports. But this generally gives you the right framework. For example, JP Morgan is predominantly fee-driven, with asset management fees making up the majority of revenue at about 70%, whereas Citi is much more balance sheet driven, with net interest income as the largest contributor to the private bank's revenue. So while we describe wealth revenue conceptually as AUM fees, lending spread, transaction, and alternatives, the real mix depends heavily on the institution's strategy and client base. In the flagship course, we dive into the exact firm's revenue model and their leading products and how they differentiate from one another. The bank with the closest revenue breakdown to the example I gave in this slide is Morgan Stanley. But this framework is the key takeaway. Recurring fees from assets, spreads from lending, episodic revenue from transactions, and placement economics from alternatives. Together, these four streams generally define the private banking business model. And here's why this revenue model matters. 75% plus of PWM revenue is recurring. Unlike investment banking's deal-by-deal model, clients pay fees whether markets are up or down, quarter over quarter, year over year. Average client tenure is 15 to 20 years at most private banks. And a client acquired at age 45 may stay through retirement, estate planning, and eventually the next generation's transition. And the revenue multiplier is 3 to 5x. A single client generates fees across investments, lending, alternatives, and planning. Cross-sell is literally built into the wealth management model. This is why the world's largest banks are investing billions to expand their wealth platforms. Let's take a step back and look at how the industry evolved, because where private wealth management is today only makes sense in the context of where it came from. In the 1990s, this was the brokerage era. The model was transaction-driven. Advisors were effectively stockbrokers, compensated primarily through commissions on trades. The focus was on selling products, equities, mutuals funds, sometimes more speculative names rather than building long-term portfolios. Advice was limited, and incentives were often misaligned with the client. This is the era people associate with high-pressure sales environments. Think penny stocks, cold calling, and the kind of behavior depicted in films like The Wolf of Wall Street. The client relationship was transactional, not advisory. In the 2000s, the fee-based shift began. As markets matured and clients became more sophisticated, the industry started moving away from commissions towards AUM-based fees. Again, that's assets under management. Instead of getting paid per trade, advisors began charging a percentage of assets under management. This fundamentally changed incentives. The advisor now benefits from growing and retaining client assets over time. At the same time, fiduciary standards became a major topic of debate, and financial planning started to gain real traction. Advisors were no longer just recommending securities. They were starting to think about asset allocation, diversification, retirement planning, and even tax efficiency. The relationship began to shift from transactional to advisory. In the 2010s, the holistic platform emerged. Private banks and wealth managers realized that managing a portfolio alone was not enough for high net worth clients. These clients had complex needs, and they wanted to coordinate all of it. This is where the full service model took shape. Firms integrated investment management with alternatives access, as well as lending and estate planning all into a single platform. The advisor became less of a product salesperson and more of a relationship manager, supported by a team of specialists. The value proposition shifted to coordination, bringing together multiple disciplines into one cohesive strategy. And today, we're in the modern PWM era. This is a hybrid model, combining human advice with technology. On one end of the spectrum, you have digital-first platforms like Wealthfront that offer automated portfolio management, tax optimization, and financial planning with minimal human interaction and no physical branches. On the other end, you have increasingly sophisticated private bankers using AI and data to enhance personalization, analyzing client behavior, portfolio exposures, and life events to deliver more tailored recommendations at scale. You're also seeing the expansion of what counts as an investable assets. Platforms now allow clients to access fractional ownership in things like art, collectibles such as watches, or even rare wine, assets that were historically illiquid and inaccessible. At the same time, next generation engagement has become critical. educating and integrating younger family members into the wealth structure early. ESG considerations, family governance, and legacy planning are no longer niche topics. They are now core to the advisory process. Now, a look at the competitive landscape, where each wealth management firm category operates with a different model, serves a different client segment, and competes on different strengths. At the top are the elite private banks: Citi Private Bank, JP Morgan, Goldman Sachs, and UBS. These firms serve ultra high net worth clients and family offices, typically at $10 million or above as the minimum. Their differentiator is the full platform: investments, lending, banking, alternatives, and global capabilities, all integrated into one relationships. By becoming a client of the bank, clients get access to the sales and trading desks, investment banking deal flow, and pretty much everything else that the bank offers. Next are the bulge bracket wirehouses: Bank of America, Merrill Lynch, Morgan Stanley, and Wells Fargo. These firms operate at scale, serving high net worth clients in the $2 to $10 million range. They combine strong brand recognition with large advisor networks. Morgan Stanley, for example, having well over 17,000 versus Citi Private Bank's 1,000 advisors, as well as a broad product shelf, often anchored around a financial advisor-driven model. Then you have boutique and independent firms, such as Rockefeller Capital Management, Bessemer Trust, and Glenmead. These firms typically serve ultra-high net worth clients at $25 million and up, and their edge really is customization. They have fewer internal product conflicts, also known as open architecture, and often a family office heritage. Below that are the RIAs, the registered independent advisors, such as Hightower Advisors, Mercer Advisors, and Creative Planning. These firms serve high net worth clients from roughly $500,000 to $5 million. They tend to be planning first, often fee only, and more regional in nature, with a strong emphasis on holistic financial planning rather than product distribution. And finally, multifamily offices, such as Iconic Capital, belonging to Mark Zuckerberg, Crescent, and Patzone. They serve ultra high-end, typically $50 million and above. They provide family office level services, governance, direct investing, consolidated reporting, without the client needing to build their own internal infrastructure. Now here's where most candidates stop. They can name the firms, but they don't actually understand how they differ beneath the surface when it comes time for interviews. A core offering of the flagship course is going several layers deeper. We break down each private bank individually, their revenue mix, their key product strengths, where they are positioned competitively, and even their interview questions. We analyze their most recent annual reports and earnings statements, walking through income statements and balance sheets to understand what is really driving the business so that you can reference exact metrics to your interviewer. While at a high level, all of these firms sound pretty similar, in reality, JP Morgan is a fee-driven asset management machine, whereas Citigroup is more of a balance sheet and lending-driven private bank, and Goldman Sachs is differentiated by their alternatives offering and performance-based revenue. Those nuances are what separates average candidates from top-tier ones who get the offer. 5 key takeaways from Lesson 3. 1. Private banking is a team sport. The private banker coordinates specialists in order to serve each client. 2. Service is holistic. One family may touch investments, lending, estate planning, and all the other services that a private bank offers. 3. Revenue comes from AUM fees, lending spread, transactional revenue, and alternative placement fees. These are the core 4 pillars. 4. The business model is built on recurring revenue, long-term client relationships, and cross-sell, which is very different from investment banking and sales and trading. And 5, the industry evolved from commission-driven brokerage to today's holistic, fee-based advisory platform. So that's Lesson 3. Now you know how the machine works. In Lesson 4, we're shifting to the recruiting playbook: timelines, pathways, what firms actually look for, and how to become a competitive candidate. I'll see you there. Are you ready to go deeper? Products, portfolio construction, interview prep, and the full recruiting strategy are on pwmpathway.com. Check it out.